Some fancy words.
Well, they're not that fancy. Mr. Kanoy?
Predetermined overhead rate.
Is that what you were communicating to Laura or something else other than that?
We were both saying, we both went.
Oh, you both said it simultaneously? So PDOR stands for what, Mr. Eisenbuth?
Predetermined overhead rate.
Predetermined overhead rate. Mr. Evans, do you recall how to calculate a predetermined overhead rate?
It's the estimated manufacturer overhead divided by the estimated activity.
Estimated manufacturing overhead divided by estimated activity. And so, how many PDORs did we use? You remembering all this, Scott? Say what one more time? Oh, were you not paying attention because you and Tony were talking?
No, you said the estimated manufacturing.
Overhead divided by estimated activity? Okay. That's really the last thing I said. But what I want to know is how many PDORs did we use last class period? How many did we calculate and use? And what did we use that number to do, Jackie? We used the PDOR to calculate what?
The applied manufacturing.
Applied manufacturing overhead. What's the formula for applied manufacturing overhead, Shar? PDOR times actual activity. And we did, and where did that number come from, go to, Stephanie? The applied.
It went into the manufacturing overhead on the credit side.
If it's going onto the credit side, is it going in or out? Out. And so it goes out of manufacturing overhead and into where? Follow the arrow brick road.
To cost of goods sold.
No, it doesn't go to cost of goods sold. It goes applied. Applied goes where? Mr. Warren? Work in process. There we go. What went to cost of goods sold? To help Stephanie out here. Catherine, what went to cost of goods sold? And she's really thinking.
The over-applied or under-applied difference. I mean, the difference
Yes.
that was over-applied or under-applied.
Goes to cost of goods sold. Very good. Because remember, over and under and through the woods to cost of goods sold we go. It happened again. At least one person, I got at least one courtesy laugh. So activity-based costing differs from job order costing in that rather than just using one PDOR, we can use lots of them. Hence the definition, the case of many PDORs. And so yes, I have given you number one. How does ABC differ from job order costing? Many PDORs. But the second way it differs from job order costing, number two, is that very often the calculations you're going to perform will involve actual information, not estimated information. So actual, not estimated. Very often. You know, so the math is the same. It's still overhead divided by activity. It's just actual overhead divided by actual activity rather than estimated manufacturing overhead divided by estimated activity. Okay? Questions, comments, concerns, random thoughts? Uh-huh. Which of the above?
If it's actual,
I'm,
then how is it PDOR?
it is. It's not. It's PDOR in quotes.
Huh?
It's PDOR in quotes.
Okay.
I mean, at least in my thinking, it's PDOR in quotes. So it isn't PDOR precisely. But I kind of think of it as PDOR in quotes. It's the same math. It's the same manufacturing overhead over activity. It's just without the estimated in front of them.
Okay.
So it's a convenient and hopefully not too confusing way to relate the calculations without making you memorize too much stuff. Okay? Very good. That was a good question. ABC steps, if you look on the next page, give you the steps. And now this is not something you have to memorize, so please don't do that. Okay, this is there just to potentially be helpful to some of you. Some of you might find it helpful to kind of, because some of these problems are going to get kind of big and complicated, and so it's potentially helpful to have it written down what the steps are. And then finally, down there at the bottom, note to self, we're going to do Audio Basics Corporation will be our example. ABC for short. Yuck, yuck. Ba-doom-tsh. Audio Basics Corporation will be the example of That was kind of a delayed reaction to that problem. So let's go find Audio Basics Corporation. What page is it on? Oh, and you just passed over some information. That'll be helpful for a homework problem later on. But it's not stuff that we're going to cover in class. So let's go to Audio Basics Corporation. We there? What page?
196.
Mr. Hutchinson? 196. So you concur with all the other numbers that were yelled out? Very good. So here we have Audio Basics Corporation. Apparently you shouldn't squeeze a water bottle while you are opening it. And this one is unusually full. Yeah, there's the real, and so squeeze, open, get hand wet. So Audio Basics Corporation manufactures two types of video cassettes, standard and high grade. At least a few people find me entertaining. And it's all on film, you know. Unfortunately, that doesn't help. You know, so they manufacture two types of video cassettes, standard and high grade. The standard cassettes are primarily for home use. The high grade version is used for for television commercials. Management believes the accounting system may not be accurately allocating costs to products, particularly since sales of high grade videotapes have been increasing. Management has asked you to investigate the cost of the allocation, or to investigate the cost allocation problem. You find that manufacturing overhead is currently assigned to products based on the direct labor costs in the products. For your investigation, you have data from last year, hence actual information, not estimated information. So we're using last year's data. Last year's manufacturing overhead was $880,000 based on production of 320,000 standard cassettes and 100,000 high-grade cassettes. Direct labor and direct materials costs were as follows. There they are. Management has determined that overhead costs are caused by three cost drivers. The cost drivers and their costs for the last year were as follows. So let's check some stuff out. If you look at the second to last sentence in the biggest paragraph above, it says how much was last year's manufacturing overhead? $880,000. So now if we look at these, we've got total overhead in this little table below of how much? $880,000. It's the same number, and it's supposed to be. So what they have done is they've said, we think there are three primary causes of why manufacturing overhead happens. Our manufacturing overhead happens at Audio Basics Corporation. And so they think production run setups is one of those reasons. And so how much have they determined? Well, how much of our total overhead have they determined is caused by production run setups? For how much? $400,000, okay? Quality testing, they think, causes how much? 360, and then packing activities, $120,000 for a grand total of $880,000. And then, so that's what they've done there. So that's step one. If you're going to implement a activity-based costing system at a company, that's the first thing you got to do is take manufacturing overhead and split it up into pools, okay? And then each of those pools has its own, here it's labeled cost driver. Here it's labeled cost driver. What word that we've already learned do you think that is? I think somebody said it. Activity. It's the activity. It's the activity associated with that particular pool, okay? But driver sounds more causal, you know? Right? If it drives the costs to occur.